All right, guys, debriefing strategies. Now, there are all sorts of different ways to debrief. We're going to go and explore a few of them. We're going to explore different variations of how you learn stuff from not just a charting perspective, but from a psychological perspective. With debriefing, this is a very personal thing. I don't think there's ever a way of saying, right, this is how you do it, and you must always do it like that. The other thing to remember there is that debriefing evolves over time. What you need to learn and need to understand at the beginning of your career is obviously very, very different to what you will need to learn as your career progresses. So this then is something that you should never see as a static thing. A debrief should be something that is there always to look forward, to guide you forward. And that's the other aspect of a debrief that is perhaps not always focused on and not always thought as the key to it. The key to a debrief is not to just track what has happened. That's writing a diary or writing a journal. It's very interesting historical reference, but unless you're going to do anything with that, unless you're going to take that and go, right, well, how am I going to turn this into a new idea, a better performance the next time I have this situation, a better way of understanding the things that affect me and the type of trades that I am good at or not good at. And if you're not doing that with your debrief, then ultimately it is kind of useless. It is a lot of extra work for no extra gain. So like with a chart, if indicators, lines, whatever you've got on a chart, you cannot define exactly the purpose of them, get rid of them. Same with a debrief. A debrief doesn't have to be vastly complex and vastly long, but what it has to have is information in it that is going to help you in the future. That's the way to be thinking about this. What you learn today, whether you trade it well, make money, lose money, is there to help you in the future and get paid for in the future. That's what your debrief's all about. So we're going to have a look different ways to go about this, from the very traditional, then moving through to some of the, what I would call softer elements of a debrief, which again, trading is one of these jobs where it is seen as very much a numbers game. It is hard facts. It is very quantifiable theoretically. The reality of it is it's not massively quantifiable without huge amounts of data sourcing and data analysis abilities. What your debrief does is it steps away from that side of it and goes, right, what is it that you can recognize in your own head? Because humans don't need massive backtesting of data to be able to understand the potential of a forward moving pattern. That's what your debrief's there to help you with. To understand how next time when you see this, you can go, right, I've seen that before, I've seen characteristics, therefore I can say that there is a good likelihood that this is going to do X, Y, Z without the necessity to have backtested that perfectly to the nth degree. You understand the propensity of something to happen, not the probability of something to happen. Right. Excuse my slightly sore throat. Let us go on. First up, why bother debriefing? I've kind of briefly explained this, but to highlight a few of those things, one of the key aspects is evolution. And the way you evolve is all about then going, right, what is it that I need to improve now, and how am I going to go about doing this? The other thing that it does really well for you in terms of being able to learn is it formalizes what you've done. I know this obviously from personal experience standing here. If you can formalize the way you go about something, how you explain something, how you do something, your understanding of it is so much greater. So by doing this, you're not writing anything necessarily groundbreakingly new, but by formalizing why you did something, what it was that you saw, the pieces of the puzzle, you have a much better understanding of what your thought process is and what exactly contributes to that being a trade, or in future potentially not being a trade. Think of this as well, particularly on your day-to-day basis, that this is there to build ideas. By building ideas, you create the ability to adapt and to move with what is going on. If you don't build new ideas and you try and rigidly find exactly the same stuff over and over, all you're doing there is you're what I call learning the drill, not the skill. What you're doing is learning how to spot something consistently, but you're not learning the skill of how you actually execute that. And that's the bit that you get by looking deeply into what is going on. The other thing that a debrief should do, and this is why you should do it at the end of the day, don't debrief throughout the day. Whilst you're in the day, you're trading what is going on. You're taking on information throughout the day. You're seeing how that can generate a new idea, how that fits into your current plan. You're constantly adapting and updating what you've already prepared. The debrief comes at the end of the day. It's a way to go, right, that is it. Draw a line under the day. Whatever happened is gone now. Now you can take a step back and debrief what has actually happened. It's a reflective thing. It's not a case of trying to solve the problems and fight the battles that you just fought. It is there to go, right, these are the things that I did. What information can I gain from this to help me next time? To start with, one of the key things is to build proficiency. To get a better understanding, and I'm sure some of you guys will have found this, to give yourself a better understanding of what it is that you actually do. Do you know the types of strategies that you use? Do you know what you will do in certain situations? Do you know what the order flow should look like in certain situations? If you don't, that's the first bit of your debrief. That's the first bit that allows you to build proficiency, to understand where you trade in reality, rather than what most people think they do, because what humans are very good at is creating a story around what's happened without that objective of going, right, this is what I actually did, so let's look at why I did it. It helps you understand your style. One of the things that I found myself is that I do have a style, I have a way of doing things, and there are situations where I can deviate from that, where I don't stick to the way that I go about doing things. And being able to identify those situations, again, it builds your proficiency, not in just the trades you take, but in recognizing whether you should actually be taking trades at the moment, recognizing what you should be doing and when you should be doing. One of the easy ways to do this, of course, is to go through and identify your best and worst performing trades. Now, I'll talk about this a little bit later on as we move towards performance and looking at things from a weekly review perspective rather than just simply going through every single trade. But what you should be able to do over time is identify the types of trades that do well for you and those that don't. The markets that do well for you, those that don't. The day types that do well and those that don't. That way, you can start chopping out the stuff that doesn't work. It's an overlooked thing, but one of the best ways to improve your performance is to stop doing the stuff that costs you money. And you will. Everyone will be doing it. Everyone can always look and go, do you know what? I don't need to be doing that. It's a tax on your trading. If you identify those things, stopping doing something is much easier than trying to find a new thing to do. So if you can work out what is actually working and what's not, then you can start cutting stuff out, which immediately prevents that pullback on what could well be a growing career. The other thing that it can do for you is it can preempt a good run. It can preempt a good run coming to an end. That's all about looking at the psychological patterns, the traits that you start to portray throughout your day of trading, throughout a sequence of days of trading as your performance shifts. The key, of course, is developing new ideas. Take trades that you already understand. Develop variations of this. One of the early things that I'll be talking about in a minute is generating a playbook. And a playbook is not just, here's a great image of a head and shoulders pattern or a flag pattern. It's looking at variations of those, situations. And this comes down to the difference between what I call a strategy and tactics. A strategy says, yep, you see this, you do this. Tactics are then, right, there are different variations of how you do it. Your skill develops in being able to go, right, I've got these different ways of being able to do essentially the same thing, and therefore you can do whichever one of those comes up rather than waiting for the perfect playbook scenario. Mentioned this already, having a way of actually defining what affects you. I'll talk about what we call a tilt meter a little bit later on. Being able to define what affects you. What this does for you is doesn't say, oh, I'll just change the way I think. And we'll talk about this when we get on to psychology. You can't change the way you think and change what affects you. What you can do is recognize what affects you and don't put yourself in a situation where you can be affected. That's perhaps the better way to think about it. We're not in a business to try to change how people think and your mind. You're trying to give yourself a framework to be able to say, right, I know that in these situations, I have a temptation to exit a trade early. So how do I deal with that? What can I do? How can I bring this into my trading to prevent that type of thing from happening in future? So that's the whole idea of understanding your psychological patterns, how they can be dealt with, how you can adapt what you do to deal with your own personality type and how you go about trading. Right. So, debrief should evolve. One of the ways I kind of always try and think about it is you start from what you know. Of course you know some things, you've got some skills. You then need to ask yourself, what do you need to know? What's going to make what you've already got better? And then go and find out. What that will do is that will create a new part of your debrief. Like I said, debrief is going to evolve over time. It's not going to be perfect and set out to begin with and just work. You need to bring new bits in. You say, right, well, how can I find this out? What do I need to start bringing into my debrief to find out about how a move really happens? What do I need to be starting to take more and more notes of? That brings in a new part, that develops a new skill. Now you know a lot more and the cycle goes round. This is how you build proficiency and build understanding of what's going on and how you develop as a trader. Right, so There's your evolution. Always think about it, it needs to be cyclical, because what this does, and I'll explain this towards the end, is it creates an exponential growth in skill. Once you know something, you add to it, your sort of range of possibilities of more things that you can do grows and grows and grows. More skill set, more opportunities, more ability to trade. Right, traditional method of debriefing. This is your kind of old school way. This is essentially what I was told when I started. Write down every trade you take. At the end of the day, go and look at what happened on each of those trades. Now, that's great, but that's not always too easy, particularly for a day trader, particularly if you are more inclined towards scalping. You're going to end up with too many trades to remember, too many things to review. It's going to take too long. And the problem that happens is it becomes onerous. As soon as something becomes onerous, as soon as you look at it and think to yourself, I can't be bothered to do that today. As soon as that's happening, you'll eventually fall out of that habit, because it'll be time to do a debrief and you'll get a phone call from a mate and they'll say, oh, we're doing this, do you want to come? And you'll look at it and go, I could do a debrief for 2 hours, or I could go and have fun. And you'll go and have fun. And that's fine, that's great. So don't get yourself into a position where this becomes onerous, because if it becomes onerous, you will fall out of the habit and it will lose all its value if it had a great deal of value to start with. What tracking all of your trades doesn't do really is it doesn't create new ideas, because all it does, it goes, right, I did this, that worked, great, yep, do more of that. But it doesn't generate new ideas. You stay with a set number of ideas and you effectively over time marginally see that one of them perhaps is slightly better than others. The main improvement you might get there is you actually drop some trades that don't work, which will mean that over time you'll actually diminish the number of trades that you can take. So after going through an onerous process of judging every single trade, you now put yourself in a position where you now need to go and research new ideas, generate a new idea, start testing it, and see if that one works. The other thing that it doesn't do is spot patterns of trading. It needs to be more holistic than this, because some trades are going to work on certain days. Particularly if you're a scalper, one of the main things to try and identify is when does scalping work best for you. Some people are very good at being able to scalp directionally. When a market shows direction, they'll be able to trade and trade and trade and trade and trade, and they'll keep on making money, taking bits out of the market as it goes. Others are much better in a more rotational type market. So what that immediately says to you is you need to recognize when a market is going to be directional versus rotational, so that you can define when is the most appropriate time to be able to push the number of trades you're doing, push the size on trades. Whereas if you just track your trades each day, all you'll do is you'll see, right, some days are good, some days are bad, some days are good, some days are bad. It'd be very hard to recognize why when you play breakout trades at certain points, they do work and then other days they don't. So it's got to be more holistic and look at the overall sense of what the day has done, rather than just simply assessing what you've done, because all this is just reflective of what you've done rather than what could have been done and what potentially could happen, the story of what's going on. I don't think this is a bad thing to do. Excuse me. Where this has value is, one, during the day, it will help you in executing trades, because you define the idea of the trade, where you're getting in, etc., etc., etc. And just by scribbling these bits of information down, what it does is it creates accountability, and it means that when you get that situation, when you get to the point of taking a trade, you are ready. You know what you're going to do. You've accepted, and this is perhaps one of the most key things, you've accepted your stop. By doing that, you can then take the trade freely, going, I know if this goes wrong, that's what it's going to cost me. I'm happy with that, I accept that, and you can then move on with your day. Perhaps the thing that I would bring in beyond what is typically there, because most people will have what the trade is, market, the context or reason for the trade, where your stop is, what the target is, or target/exit price, and that will be it. Result, that's key. When I say result, what I mean by that is what actually happened on that trade. Did it go to the target if you got out earlier? Did it go to the target if you got stopped out? Because this way, what you're trying to do is you're not trying to go, okay, so that trade worked, good, tick, because it may not have worked. Let's say you enter at 50. For whatever reason, it's a range-bound market, let's say, range-bound market. Your stop is at 40 and you get out at, or you have a target of the top of the range at 75 and you exit at 45. Now, some people look at that and go, result, plus 5 ticks. Great, good trade. It's a crap trade, if we're being honest. You've taken a 10 tick risk on a trade, you're looking for a rotation up a range, and you've got out after 5 ticks. It's barely even bounced off the bottom of the range. But the easy thing to look back there is you go, well, that's a profitable trade, good. Happy with that, a little smiley face, and everyone's pleased with themselves. Now, that's not going to help you. You need to go and focus on this bit, the result. If this was the objective of the trade, what happened for the market to move? Did it go to the target? Did it not? If it didn't go to the target, what happened? Because that then is giving you the ability to look forward and say, okay, well, this range bound market, I bought it down here, I had a stop at 40, and actually what happened is the market went, traded 50, traded down to my stop, and then continued on. So what happened here? But if you're just looking at it as a trade by trade perspective, you look at that and go, well, it works out because I got out for 5 ticks, then the market dropped, good times. So you've got to make it pause it there very briefly. Excuse me, the aircon went nuts. Look forward. You've got to make it look forward and see what else could have happened. So if there's nothing else that you put in, the result of each trade is really vital in terms of what actually happened after you got out of that trade. This way, you find new trades, you find new ideas. The other thing, now track is mindset. How did you feel getting into that trade? This will help with assessing your mindset going forward and identifying different tilts. Particularly early on, you don't know what it is that affects you. So just write down what you felt, how you felt. Were you frustrated on the exit? Were you frustrated on the result that you got? How did you take the loss if you took it? How did you feel on the profit? How comfortable were you in the trade? So it does have value, but make sure that you extract the value by looking at the results and what happens next, rather than just simply I did this, this happened, I got out there, and that be it. Another way to do it is to ignore the trade by trade and look at the day as a whole. And again, this is something I'll be doing throughout the day. This isn't a debrief. This is just something that throughout the day, for each hour, you don't have to be spot on turn of the hour. A lot can happen on the turn of the hour, but just roughly throughout the hour, any data that happens, how the market has changed, information gained, any trades that you've taken. I've left score in there. That's something that I used to previously have on a sheet like this, where I would give a score to trades that I've taken. Now, the problem with that, and where I've moved away from this, but I've left it there for completeness, is that, like most people, I'm relatively modest, and what a lot of trades became is most trades were, if they were good, were a 7 or maybe an 8 if they felt particularly good, and trades that were bad were generally a 4, and then if I was particularly annoyed, one trade might be a 1. So actually, it didn't give me a great deal of scope as to what was good or wasn't, because I was never willing to say, yeah, that was absolutely perfect, brilliant. And equally, I would either go, that wasn't good, 4, or something that probably wasn't actually that bad, 1, which psychologically is quite dampening on your confidence. So I actually dropped that, but you can keep that if you want. Again, like I say, it's about making this personal to you. What this will help with is, 1, throughout the day, keeping track of what's going on. Remember, we talk about this with how you do your prep and making sure that you've got the energy for the day. This does that because it keeps you thinking in the narrative of what's going forward, continues looking forward at the story rather than just looking backwards at what's previously happened. So make sure you're asking questions about what did happen, how did you react, and what does that mean now? It also helps you when it comes to doing your debrief, because now you've got references which are really easy to just flick back through. You go, okay, I know what happened on the day now, and that makes reading the chart so much more understandable. You see some people's debriefs, and after a while, and people will do this, they will get a little bit lazy, and their debrief will just be charts, charts, charts. And that's great. You can spot patterns, you can see what's happened in general, but by having something like this, you can then go, right, I can make sense of what happened on the chart, why it did this, why it did that. It also forms a real easy base, because this is half your debrief done now, because you've got all the information down that you need. You get the charts in, a bit of annotation on the chart, and you've accumulated information. Remember, a lot of a debrief on a day-to-day basis is about just accumulating information, which you can then use later on to develop new ideas. So break these things out a bit. Right, so let's move through debrief evolution to what do you need to know and how are you going to find this out? A couple of the early stages for people as to finding out what they do, how they do it, and how they're going to do this better. Right, gaining information. One of the things that I would recommend to anybody, and this is interesting because it's something I've heard other people suggest without ever speaking to me, is at the end of each day, get a 5-minute chart. And I know software will do this for you and point out where you took each of the trades. But at the end of the day, get a 5-minute chart and annotate on it where you took trades, what you did. There's value in actually writing it yourself, and I'll explain that a little bit later. But what this is starting to do early on is to define for you what trades you actually take when you take certain trades. If you look back at this at perhaps the end of the week or even the following month, there will be situations where you look at that and think, what was I doing there? Why would you do that? And that's showing a deeper understanding of what's going on. So this is essentially the beginnings of a playbook, because by doing this, what you're starting to do is you're starting to recognize the types of trades that you take. When you take these types of trades, are you somebody who waits for a move to get going before becoming active? That's quite apparent here. And the way I distinguish, I'll explain on the next slide, is by coloring differently. Move starts, then some selling. Movers move, we've got the move, we've now got a flag form, now there's an attempt to buy. Looked at trades taken. This is somebody who will wait for the move to happen, wait for confirmation of what is going on, and then act. And that's not bad. There's nothing wrong with that. It's about understanding what you do. You want to wait for something to happen and then draw your conclusions and act on that. And so this way, you can now start to see where you make your money. This one, waited patiently for the trade, get long, you take a decent move out of it. In fact, manage to get out up here and then even manage a short for a short-term reversal trade. So there's a bit of direction based on what's happened as well as a scalp element to this trade. So you're seeing different ways that you go about doing things. Here, clearly a little bit of an uncertain reaction. After a drop, both of these are scratched. More of a breakout trade here. A reversal mistake, going long and then taking a loss, but being able to turn that around quickly into a directional trade to the downside. Again, up here, a lack of conviction, one would assume, like here. Selling up here and getting out for a scratch, selling up here and getting out in the middle of the range rather than trying to play for this move, there is clearly a sign of a lack of conviction in what is actually happening. Just by doing those things, you can ask yourself later on, well, what was it? Why did you not believe in that trade? Why did you not sit with that trade in the same way that you have done here? Perhaps it's to do with the amount of trade that you take. And I'm not trying to say there's a simple answer to any of these. What you're trying to do is you're trying to say, okay, well, what was it? Why did I do that? How was my thought process? What was it that got me to trade in that type of manner? Another example. This is a good example of looking at, and one of the other aspects I wanted to draw on this is making distinctions to make the trades easier to spot. Because again, when you're annotating the chart, when you're putting the information on, you'll think about it a bit more. So, well, why was I doing that? What you can see here is there is certainly a propensity to go short on this day. All of the red are short trades, all of the blue are long trades. And there's certainly an inclination to go short. But this is perhaps misplaced. What you see here is a lot of trades. 1, 2, 3, 4, 5, 6, 7 trades, and the majority of them done here. That can start to answer questions as to, well, clearly there was an idea behind the trade. This is obviously the first trade. And if you get a bit of information as to why you took it as well, which you will get from having tracked those trades along the way, you can say, okay, short of the single prints, fine, that makes sense. Market sells off, bounces back to single print, you're looking for that. That makes sense. But on the back of that trade not working, there's then another attempt at a short, another attempt at a breakout short, a quick breakout short, another attempt at a short, long. There's a lot of getting chopped up in here. That's an indication that, well, once your idea is gone, there's not a willingness to then step back and go, right, I need to find out more information. And perhaps that then tells you that one of the ways, and always think about this in terms of what do you need to know. One of the things that you need to know here then is how to better identify a change in what's going on. You're clearly not tracking the information that's coming in to tell you that, well, this has not worked. Once that trade's not worked there, then you're into a different realm of working out what exactly is going on before jumping into multiple trades and then giving up once there at least establishes some degree of direction. Whereas counter to that, if you think about looking at the phases of a move, what you get here is you can see where the activity is. Far less trades. There is one attempt at a short early on after a move up, starts to reverse, one attempt to a short, and then an exit as this bounces back. Okay, so that trade doesn't work. It then becomes relatively clear what the direction is. But this is a good sign here that this market has moved into a very steady grind higher. And what you can take from this is that there's clearly, when a direction is established, there is clearly an understanding of getting into the trade, understanding where your opportunity lies, and then waiting for that opportunity. So there's patience when direction is clear. When there is not, then patience is lost. Frustration builds clearly and opportunities are gone. And that's what's happening here. Patience comes in, news spikes the market down, chance to buy, play the move back up. It may only be one trade, but what it exhibits is a willingness to wait for the opportunity, to be patient in the way that you're taking the trade on, simply because it would seem that this trade is quite clear on what is going on here and therefore waits for the chance to act. That's what you're trying to do. You're trying to work out what it is that you do in certain situations. You can then add this on to the different types of day that you're seeing to understand better what those types of days look like, identify the day, and then go, right, I know what these days start like. I can start to push it a little bit more on these days. When it comes to actually breaking down trades, individual trades, there's one thing to just look at all the trades you've taken to get a general sense of what you do. The breaking down trades, I'm more going to be looking at this for someone who is a little bit more infrequent in the way they take their trades, someone who is looking at a larger move that perhaps has multiple aspects to it, i.e. you might add and add, exit parts of the trade, look at the trade from that perspective. If it's something that you're trying to build the skill up of how you take on these bigger, more directional trades, then I would break the trade down a little bit more. This is one of my own where I was looking at this much bigger move on an hourly chart. It's not typically more along the lines of my style, but what I was trying to do was learn, right, well, how do I run a trade like this? How do I get into the trade and let the move happen, let the trade go to what was established as a target? So I then had to break the trade down. Ask yourself as well, this is perhaps one of the most important questions when you're breaking a trade down. Not did it work, because by all measures, this trade worked if your viewing worked as profitable. Selling up here, exiting down here, it's a profitable trade. Great. You've got to look at this in comparison to the actual plan of the trade. Relive the trade as well. What you're trying to do by reliving the trade is you're trying to break down how it felt as that trade happened, what it was that caused you to have confidence in the trade, what it was that perhaps in future may allow you to enter more where the original entries were, potentially enter higher up. So don't just look at the bit where you're in the trade, look at what happened up here. Could you have been in here as opposed to your first entries down here? I think it is a far stretch, and I remember doing this in my own debrief of looking at this and thinking it's a bit of a stretch to say, well, it's an inside day break that hasn't happened to the upside, therefore sell it from here and play that move. That's the kind of trade that in hindsight is wonderful, and you go, yep, absolutely, that looks wonderful, yeah, I'll do that every time. It's a trade that, in reality, in the moment, by reliving that trade, there was no thought in my head up here that this is going to fall out of the sky. That was a failed inside day break. I now needed more information. So when it comes to the trade, go through what happened, what influenced your decisions, were there any key order flow takeaways? The bit that got into the trade, because the first part of the trade was basically chasing the move down, selling it into the low, and taking a quick loss, realization that this wasn't the best thing to do. There was actually somebody spoofing the bid, and I've seen this many times where you'll get a directional move and somebody will spoof the market at the low so that they can get their position short, and then let it go. I saw that, and that to me was an opportunity, not then just to get in, but to get in and add to the trade. So then, rather than just being able to sell one clip, able to sell 3 clips here, with confidence that I'm selling it at the low, so just around this level here, but with somebody spoofing this that is helping me out. Then you want to look at, well, okay, where can the improvements come on this trade? And this then can come down to 2 different aspects. Could you add more size? Was there a reason to be able to get more in here, or potentially higher up? So go back through that part of the trade. Could you have held this longer? Now, when I say longer, what I would not be advocating is going, well, I could just hold it and let it run. You're not looking at that. Could you have held more of the trade for longer, i.e. all the way to the full target? That's the question that you want to be asking. The idea behind the trade was that this looks like a trend type day. So the plan was to run it until the European cash close and then leave a small part of the trade to run to the 9 p.m. close. So this isn't a case of just let it run. There are parameters around that. There is a clear distinction as to where this is going to run to. So what you then want to be looking at is, right, well, where did you exit the trades? We've got the targets defined here: 72, 60, 51 to 47, 34 and 11. So the targets come in here, 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 and 11's down here. So all the targets have been met, but then when you look at it from the perspective of where were the exits? Well, there was an exit up here, just above the target. Was that necessary? That's a hurdle. That was the first moment to find out whether this had more legs. Yet a third of the trade has been covered there. That's not a good part of the trade. That's something that in the future, part of the strategy there came that this is one where you have to say, right, until you get past there, I'm willing to accept a loss and I'm not going to get out before that. I would either lose on the whole trade or I would get out for a better price than before the first level. So that's the first aspect. The next exit, I think, is absolutely fine, just at the level. The mistake and the bit that I felt most frustrated about on this trade was this exit. That was an exit that for me was one where, if you take it back to the question of, if I wasn't short, would I sell it? Absolutely, that is where I would want to sell it. That's where you got a pocket of low volume. That's where you clearly found some resistance. That is where you want to sell it. Your stop then can go above the previous target at 72. That's a great place to sell. But instead, having watched the market bounce, the thought process changed to, not on a good run now, probably best exit some of this here. So we're going back through these things. This then is a classic one of having to then say to yourself, right, I need to bring in a method to counter my temptation to exit trade here. And by doing that, you give yourself that ability to go, okay, I know this is uncomfortable. I know I don't really want to be holding this, but the flip of that is that logically, if I didn't have a position, I would absolutely be selling this. That's the bit to start to bring into your question. It's a question I ask myself a lot. If I didn't have a position, what would I do? And often you'll find that the answer is sell, in which case buying is absolutely not the answer. And then the rest of them, that's a decent exit, taking advantage of the direction. That's a decent exit, taking advantage of the exhaustion. That's all good. You can't do much with something that doesn't run all the way to the close if it doesn't run all the way to the close. So another exit, that's a case of part of the plan has been stuck to. So some good exits. Clearly, where the mistakes come in this trade is when you're not being shown immediately that the move is happening, there is doubt on the first exit, and then where it pauses, which is natural on a trade like this is a larger move, where it pauses, then looking at trading going, oh, I don't like it. And that leans back to the previous ones, which is about assessing your style and your personality. I'm naturally somebody who's impatient. I want it to just move. When it moves, happy, get some good results. But when it doesn't, and it doesn't give me that feedback, that's where I start to doubt the trade. This is then something that comes into my mapping and visualization of a trade like this in future, where I can say, right, I know what this trade looks like. I know I'm going to have to deal with this type of action where it pulls back. And I need to now have a strategy to deal with that, which predominantly is about moving your stop and stepping away from the trade. Leave it, accept the quieter period, let it do its balancing out, and then go. And remind yourself, this is necessary. The faster and further this goes in a straight line, the harder and harder that move is to actually sustain and genuinely reach all of the targets that you're looking for. So that's the idea behind going back through that trade, reliving the trade. This is a trade I took quite some time ago, but because of the fact that I've gone through and relived it and explained it, I know exactly what it felt like. I know exactly what was happening. And that's your goal, to be able to go, right, I know exactly what happens in these situations. So then next time you're faced with that situation, you're already comfortable. You already know what you're going to encounter and how you're going to deal with it. So an alternative to writing down what has happened on every trade, screen recording. Quite simple, get some kind of screen recorder. There's loads of them out there, so I'm not going to go through what to get, but get a screen recorder. This way you can track what's gone on. Now, the important thing, if you're doing this, is to not then sit there and watch back hours and hours and hours of screen recordings. What you've got to do is to look at it, excuse me, and use it to break down specific trades. Now, if you're a scalper, and one of the reasons for not writing down lots of trades is the fact that that is very long-winded, well, what I would be doing is cutting the videos into phases of scalping. You'll likely go through little phases where you'll do quite a few trades at once, then a break, and etc., etc. Go back and review each of those phases. Look at the types of trades that you're taking, how well you performed during those phases, and what the market was actually doing. This way, it gives you a much better understanding of what you do and where you do it well. It'll highlight those trades that you perhaps need to stop doing. The other thing that screen recording is really useful for is to build exposure, particularly to things that don't happen very often. The difficulty with payrolls, CPI, month ends, option expiries, all of those types of things, is that you only get 12 shots of that in a year. So that feedback loop that you generate is very, very slow to come round, meaning that what you picked up last time, you realistically are not going to be able to remember that well for the next time. But by having these recorded, and a lot of traders will only record events, by having these recorded, what you're able to do is then go back and look at every single variation of the same thing. It gives you a much deeper understanding of what's going on. And it's also a great way of doing what I call a warm-up. If you're about to trade CPI, payrolls, whatever it is, you go and watch some of the previous ones. You would have seen this with a replay. Go and watch some of the previous. And what it will allow you to do, or enable you to do, is to visualize it, be ready, used to the flow, used to the pace of the market. As much as you can say, oh yeah, I know what it was like last time, there is nothing that is preparing you as well as being able to relive that by going back and watching it and watching how exactly you traded it. It builds confidence. It makes you much better at judging order flow, price action, when you see it next, because you're creating this very, very strong visual image of what exactly it looks like on a breakout, when a breakout fails, as you bounce off a level, what absorption looks like. All of those things you're able to very clearly kind of just reproduce an image of in your mind, which means next time you see it, your recognition is almost automatic. The other thing that is really useful to do is to go back and look over trades that you've taken, bigger trades, how exactly you took the trade on. And what I would do with that is save this for a weekend. Give yourself a bit of time between when you took the trade and when you review it. Because what that will enable you to do is go back, look at the trade for what it is, and ask yourself, well, what should you do here? How should you be taking this trade on? So essentially, talk yourself through what you should do and what's happening. What you'll find there is you're kind of watching back and talking through what you should do. You'll see yourself doing things on the recording and think, why did I do that? And that immediately points you down that path of, well, what do I need to know? I need to know why I did it. And so that then brings in a new element of trying to find that bit out, a potential new part of your debrief. So create that little removal. Watch it as if you're watching somebody else trade and you're advising them on what to do in that situation as the move goes. So think about it like that. This way, you're much better at recognizing not just whether a trade works or it doesn't. That's the basics. But you're also better at recognizing the types of things that you see that affect the way that you think about it, that affect the way that you might enter or exit a trade at any one point in time. So that's the value of screen recording. Make it focused. Don't just record screens and try and watch endless hours of stuff back. You won't pick anything up. And what you'll do is you'll get bored, you'll become accustomed to what you're seeing, and it'll just kind of float by without a great deal of thought. Right. So now that you've generated some information, you've got some stuff to think about, some stuff to look at, it's about creating a new part of your debrief. And so here what we're going to do is have a look at how you go down the traditional way of doing things and creating a playbook. Now, I'm sure many people have heard of a very famous book called The Playbook, which basically details how to do it. I don't think you need to read the entire book. You could read the first few chapters and you get the gist of what you're trying to do. I'll talk a little bit about Evernote in a bit. Evernote's what I've used for a long time to log trades, to log different items, different things that happen. And so therefore, for me, that's always been my go-to for noting down ideas and keeping a track of what goes on. People use Notion now, which I know is somewhat more complex, but provides more opportunities to kind of cross-reference stuff. It's up to you how you do it. Again, make it personal. Pick something that works for you. But the essence of and the framework behind creating a playbook doesn't change. The whole idea of creating a playbook is to essentially create your own textbook of potential trades. Rather than just reading a textbook, and Murphy's the one that everyone cites as your technical analysis textbook to read, Rather than just going through and reading all of these things, what you want to do is essentially try and create your own. These are trades that you have detailed, so you understand when you take the trade what it is that you're looking for on this trade, rather than trying to sit with the formulaic, standardized versions that you will see many other places. And a quick way to do this is just pick one trade every day. You don't have to have taken this trade on necessarily. Pick something that happened that you're interested in understanding more, and go through that in detail. Go through when the move started, what preceded the move, why did it happen, what other markets were moving at the same time. Every detail that you can get down, but try and be consistent in the details that you are looking at. So consider the market structure. When you're looking at this trade, you're trying to categorize different things that the trade has about it. So the market structure is what I would say falls into situation. Are we on a trend day? Are you on a range day? Are we moving out of a wider trend? All of those bits of information give you that contextual understanding that allows you to then better see variations of trades. Over the initial phase of creating a playbook, you are just looking at basically setups, and then these are going to grow and expand over time. Ask yourself then, with each one of these trades, what is it that says this trade is on, this is when to execute, this is how to access the trade, and what order flow can be expected. So try and get down all of these details. Now, to start with, it may feel like you're shooting in the dark at different stuff. And some of the things that you are shooting in the dark at, you genuinely are shooting in the dark at. You may never see another instance of that again. And that's part of the kind of, the fishing of a playbook. What you'll start to see is, very quickly, you'll start to see certain trades cycle around again. I've seen that one before. And that then comes another variation into your playbook. And so then what you can start to do is create different variations of what I've got in mind here. VWAP trades, caught in the hole trades, S&P limit down trades, trend days. What you try to do is catalog a series of different variations of these, so that then, rather than you having this perfect example, instead what you've got is all the different variations in different ways that essentially the same thing can look. It has its own little nuances. That's the bit, that's the detail that helps you execute a trade better. Having a general idea of what happens and what a trend day looks like is fine, but it's the detail of when it looks like a trend day. What is it that says to you, yes, that's a trend day? That detail, that's the bit that you're after. What I would start to do as well is to then break your trades into broad categories. Simple way to do this is into breakout trades, reversal trades, and continuation trades. Most trades will fall into this. The other one that you could have is event trades. Now, for me personally, the way that I deal with event trades in my sort of overall debriefing notes is that I will have things like option expiry events. I will have central bank events. I will have data events. So what you have there is, rather than trades for each event, I've got a series of examples of non-farm payrolls, CPI, ISM, GDP. I've got all the past examples of the Fed, of the ECB, of the Bank of England. This way, I can go back and I can cycle through those and understand what was going on and how these events played out, what caused the move that happened, and how I went about trading this. So from a technical perspective, you're looking very much to kind of treat these into a broad categories of breakouts, reversals, continuations. The reason for this and the aim of a playbook is so that you're not rigid in your approach. Playbook generally implies rigidity, that you go, right, this is out of my playbook, bang, there's the trade. But what you're trying to do, particularly from a day trader's point of view, is create a sense of, if I get this situation, I've got multiple different ways that I can take this trade on. And I don't know which one I'm necessarily going to use, but whichever I get, I know what to do and I know how to play it. So you kind of take the general situation and then you can say, right, I'm looking for a reversal. What different types of reversal trades do I potentially have? What is applicable in the nature of this current move? So that you can then go about genuinely taking these trades on. That's what I'd be aiming for. So I kind of try and think about a playbook as category, then variation, then situation. I'll talk that through in a moment. One of the best ways to do this, at least just to start with, and again, if you're creating a playbook, and we'll talk about this quite a bit, about reviewing trades at the end of the week to generate a better understanding. With your playbook, what you want to be doing then is creating your playbook at the end of the week. What I've got here, for example, is a review of a trade that happened on an individual day. down here, and there are the other previous days as well. Tag them. So give your trade a name. So if you've got a specific trade, give it a name, and then at the end of the week, you can go and put that trade into your playbook. For example, a trigger point trade. And within this section lower down, I've got a caught in the hole situation. I've got a delta confirmation trade, various other bits and pieces of information. Then I can take each of those, click on the tag, and then go and find all the other variations of it. One thing, or one bit of advice on this, because a mistake I have made, and almost to the point I've gone so far down this route that the tags have become somewhat irrelevant, is make sure that you have a clear strategy for how you tag things. Whilst I thought I was very effective at tagging things when I first started, tagging everything and creating multiple tags for every note that you create gives a situation where you end up with so many tags that it's hard to decipher. So more what I would be doing is try to have tags of similar names but different variation. So for example, if you're looking at a trigger trade, you would have trigger point breakout, trigger point continuation. And so then you'll have all of the similar trigger point trades, but then different variations of that. So you get the ones that are in a continuation phase, the ones that are in a breakout phase, the ones that are a trigger for a reversal phase, all of those different variations of a trigger point trade. So that's how I would do it. And better to set out your kind of idea of your nomenclature, your strategy for how you name things before you start tagging and naming everything, rather than tag and name everything you see and then have to try and remember these new names that you've conjured up. So just a little word on tagging things and trying to to make these things a little bit more efficient, a little bit more effective. So, like I said, categorize things broadly. Then you have a subcategory of a variation. So if this is, say, reversal, what different variations of a reversal do you have? And then different situation that it is in. You could change this and do situation first, and then, so let's say you're in a upward trending market, so situation, then the type of trade, and then the variation of the trade within that situation. So as long as you keep the consistent nomenclature, it's absolutely fine, however you want to do it. I've gone down this route where basically I have a category of, right, this is a reversal trade, this is the variation of the reversal, and this is the situation in which it is happening. So as part of the playbook then, I've got multiple different reversal trades. What I'm doing is I'm giving myself the best chance that if I get another reversal trade at some point in the future, I can, right, I've now got X, Y, Z different ways of being able to take this trade on rather than being limited to one individual way of doing something. Let's go take a look. I'll run you through a few different examples. And what you're trying to do here is you're trying to work out different types of trade that you can see in certain situations. And you're also then looking at similarities within trades. So that then what you're trying to do is you're trying to define, and this helps you generate any kind of strategy. You're starting to try and define what it is that is a prerequisite to a trade, what it is that is kind of helpful to see, but if it's not there, the trade is still viable. So the bits of information that can kind of tell you whether this is a trade that is genuinely there to be taken. You know, there'll be some information that you will look at on certain trades and say, well, without that, I can't take the trade on. So that's what you're trying to do by creating a playbook. And you may not know what those things are to start with. By creating a playbook of different reversal trades, for example, what you're then able to do is go, right, what is common about all of these? What is common about a lot of them? What is not common at all? What is there on some, there on others? So it's helpful, but if it's not there, you'd still be willing to take the trade on. So take this one, situation. This is a reversal after a ledge break, no shift in value. So this is a trade that breaks late on in the day, grinds lower, there's your ledge, value doesn't shift. So the trade is a next day reversal, and it's a block reversal on a failed break. So break of the low, doesn't continue, block reversal, delta's rising, and then you get the grind move back up. So that's one variation. And you then then you can look at all of the similar block reversals. You can look at all of the delta reversals. So you're giving yourself a way of being able to compare different indicators essentially. So with this block reversal, you get the delta jumps up from the low, so the low's here, failure to go lower, delta continues to rise, then you get the breakout zone, and then you get this traditional grind back up delta reversal type move. The situation is important here, of course, because value has not shifted lower. So it's not to say this is the exact way to do it. What you're doing is you're sort of being able to then think creatively about what other things could you see and how could you play this in future. So, situation, this is an intraday reversal on a non-correlated move. One of the things I've got written down on here is it's a drop. This is the DAX. It's a drop in the DAX with the Bund, but the S&P is not following. So it's only European stocks that are selling off here. That then creates a mismatch correlation. The European equities drop without the US, but also drop with the bonds, which is not typical. So this is a correlation reason to look for a reversal. So the situation gives you the ability to kind of prompt you to go, this could be time for a reversal. And then you're now looking at, right, well, how could that play out? This I would call your kind of classic delta reversal. Forms a pennant, forms a structure at the low. Delta rises throughout the drop, so it rises from here. So that point where delta is then rising from, that's kind of your target back up here. So you've got clear targets, you've got reason to be looking for this, and then you've got this very clear break the pennant, and then you get the liquidation part of the trade as well. So you see a slight variation, but they're all still reversal trades. One's a block that's done in the overnight and then drift up. This is an intraday delta reversal type trade. You then have grinding trend reversal. So this is a very directional day, steady move up. The variation on this is a channel break, it's a switch trade, but it is nevertheless a delta reversal. Delta peaks here, market trades a little bit higher and then drops back down. But the thing that you can then start to bring into this is, bearing in mind situation, this is a clear directional day. So it means that you've got a small target on this one. Unlike the others, this is not a target for a reversal. This is a target of some way back, and that's about all you're after. So much more limited in what you're looking for, but that then helps in the way you take the trade on, because you understand it. You know in future when you take this trade on that because of the situation, you're not going to go trying to play this as a wonderful entry point and a collapse, because that's not viable. You've seen this situation, and the situation dictates the move. It's not likely to be a sudden rollover and complete directional move towards the downside. Next up, this is a strong trend day. So part of the idea of creating a playbook is not just to put in all of the lovely ones that work. Oh, look at that, that one works, that one worked, that one worked. Your job's not to teach other people what it looks like when it works. Your job from a debrief and from creating a playbook is to also identify when it doesn't, so you don't get caught doing it. Because this has all of the traits, at least from the variation, the actual setup side of a reversal. Delta's going up throughout the move. You get this block at the low. You've got a trend to break. All of this is saying to you, yeah, here you go, reversal trade. The problem with that, of course, is that this is very clearly not a reversal looking day. You've had a rally, 2-day reversal situation, trend down, trend break, continuation. Is this a day where really you should be playing reversal trades? No. This is not just an intraday reversal. This is an attempted reversal against a very strong trending move to the downside. Not the day for it. So despite the fact that it looks good, you're able to then go back over a trade like this and say, well, I've seen this type of thing before. I'm not getting sucked into the easy trade here, knowing that you've seen examples where, yeah, it will give you the chance, it will give you the break, and it materializes into nothing. You don't reach any recent reference point. There's no reason to have got out of this trade. You're taking a loss on it. So by understanding that, and this is the point, it's not just about going over trades that work, so going, wow, look how great I was for spotting that. It's about going over a trade and saying, well, that didn't work. Why? What happened? How can this be adapted next time? Is it a case that this just simply doesn't work? And therefore, the solution, if you will, is to just not do that again. Don't trade these situations again. So you then have a new skill. You've developed a new skill in spotting reversal trades, variations of reversal trades. Now, this is always going to grow. This isn't something that stops there and you go, right, that's it, I'm done. I've learned reversal trades now. I've got everything. I'll just do reversal trades. What you've done is you've learned a new skill. But now you know something. Now you can ask yourself, what more can I know? How else can I use this skill? can I use this skill? Looking at a wider context. And this then brings in a new aspect of your debrief of getting in the much wider context of what's going on. And so the situation here is we can see these pretty bad highs up here. You can see how that move could break and run higher. The problem with this move is that the move up is a very steady grind. And essentially, it's just a reversal of the previous week's move. So it's not a move that is really screaming out to you, lots of energy, break, charge higher. Yeah, remember, this has come a long way by the time it reaches the breakout point at the end of a week, which on the whole has been a lighter volume week than the previous high volume week. So the volume's there on the sell-off, is not there on the bounce. So what you're able to do now is try and preempt the situation. That you're taking a sort of big to small approach. The situation now suggests trades that you might well be able to look for. You're using that to say, right, I could be looking for a reversal here. If we get this stretch, steady move up, payrolls pops the S&P over the high and it doesn't keep going, now I can look for a reversal back. Doesn't mean it has to happen, but because you've got that ability to understand these variations, you then say, right, well, there's the payrolls move. Now we hit the cash session, the main session. So you've got an overnight positioning move to the upside. You've got delta reversing from this area here. You've got a steady grinding trend on top of a very long grinding move throughout the week. This now gives you the opportunity to play for a move towards the downside, to potentially reverse the entirety of the payrolls move. And so that's then giving you that extra context. You're now looking at this of using your skill set of a variation of a reversal trade to now play this into a much wider contextual trade. And when you can see it from that point of view, these trades now that perhaps have got a little bit to offer, suddenly have got so much more to offer, because you can now see how very clear understanding of entries, very clear playbook of how you do certain things means that now you can go and attack this and look for a full reversal of payrolls and potentially then a kind of bump and run situation for a move even lower. That's the value of a playbook. It's not just about trying to find defined examples of things. To start with, absolutely. Build up as many different examples of different types of trades as you can. And don't rest on your laurels again, well, I like reversal trades, I'm just going to look for those. Force yourself to look for other stuff. To go and review breakout trades. Because it's only when you go and review something and break down what happens and how it happens that you understand it enough to then have the confidence in future to be able to go for that type of trade. That's the way you want to try and think about these things. Next up, day by day method.